So let's talk about Chapter 10 Income Tax Act in Canada and the Expropriation Act. Um, we want to identify the risk under the Income Tax Act for a buyer when the seller is a non-resident of Canada and is subject to special provisions regarding the capital gain tax collection. Explain provisions with respect to the seller's income tax in the agreement of purchase and sale for the protection of the buyer. Discuss capital gain calculation, including consideration in determining whether a gain in the capital is gains capital in nature or taxable income, or rent criteria in determining whether or not a home qualifies as a principal residence. Explain the expropriation process, including provisions for the protection of property owners in the Expropriation Act. The Income Tax Act Canada. The Income Tax Act is a complex legislative document which affects a wide range of personal and corporate activities on a personal basis. The Act sets out requirements regarding capital cost allowance, independent contractor activities, allowable travel expenses, personal expenses, and the promotional activities, etc. Similarly, a host of corporate rules are in place concerning allowable corporate expenses, taxation of corporations, and the related matter. In terms of a real estate transaction, practitioners require selective knowledge of the Act concerning such items as the capital gain on the selected properties, capital gain versus business income, definition of principal residence, allowable rental expenses, capital cost allowance, and collection of taxes from non-resident. The CRA is responsible for the administration of the Act. Disposition of the real estate. Section 16 of one of the Income Tax Act set up provisions for the collection of capital gain tax payable by non-resident sellers. The Act establishes a procedure requiring non-resident sellers to remit in advance of the disposition a calculated amount in order to obtain a certificate from the Ministry of Natural Revenue, or alternatively to be remitted by the buyer on the seller's behalf within 10 days following the sale completion. To recap, the Income Tax of Canada is a complex legislative document affecting a wide range of personal and corporate activities. On the personal front, the Act sets out requirements regarding capital gain, cost allowances, independent contractor activities, allowable travel expenses, personal expenses, and promotional activities. Similarly, a host of corporate rules are in place concerning allowable corporate expenses, taxation of corporations, and the related matter. In terms of real estate transaction, practitioners require selective knowledge of the Act concerning such activities as the capital gain on selected properties, capital gain versus business income, definition of primary of the principal residence, allowable rental expenses, capital cost allowance, and the collection of taxes from non-resident. The CRA is responsible for the administration of this Act. Disposition of real estate. Section 16 of the Income Tax Act sets out provisions for the collection of capital gain tax payable by non-resident sellers. The Act establishes a procedure requiring the non-resident seller to remit in advance of the disposition a calculated amount in order to obtain a certificate from the Ministry of Natural Revenue, alternately to be remitted by the buyer on the seller's behalf within 10 days following the sale completion. Essentially, the essentially buyer or non-resident seller must pay a specified percentage of the amount by which the proceeds exceeds the just cost basis for the property. Practitioners should be aware that the disposition of depreciable property may complicate situations, as the recapture is a consideration in establishing the amounts to be withheld. The agreement of purchase and sale addresses this issue of non-residency of the Income Tax Act. The buyer shall be credited towards the purchase price with the amount, if any, necessary for the buyer to pay the of Ministry of National Revenue to satisfy buyer's liability in respect of tax payable by the seller under the non-residency provision of the Income Tax Act by reasons of this sale. Buyer shall not claim such credit if the seller delivers on completion of the prescribed Settles on completion of a prescribed certificate or a statutory declaration that seller is then a non-resident of Canada. This clause requires that necessary amount be credited to the buyer by the seller to to satisfy the non-residency provision of the Income Tax Act, unless a certificate from the minister is provided to the buyer. This carefully worded clause is important, and as the buyer is liable under the Act for the tax owned by the non-resident seller. Expert advice on such matters is strongly recommended. As added note, a special rule applied to disposition involving depreciable properties and the sale of cottage properties where the land was purchased by the non-resident and the structure was subsequently built. Capital gain. Capital gain refers to the gain for the disposition of capital properties, quantity of which must be added to the taxable income on the disposition of the asset. This section of the Income Tax Act was introduced in 1971, commonly referred to as the valuation day. The capital property includes any item from which a capital gain or loss would be realized. It includes depreciable property. Capital gain calculation. A capital gain is a gain on the sale or exchange of capital assets that meets the criteria for the capital gain as set out in the Income Tax Act. Two real estate examples are provided. The first details a gain by a corporation, including the calculation of taxable gain based on the assumed taxation level, and the second provides the calculation of a gain realized by the individual. Calculations may vary based on the type of the property and circumstance surrounding the investor or the owner. Both examples assume that the gain realized meets the criteria for capital gain. $134,000 capital gain. So it's so again, for in case of a corporation, the sale price is, let's say, 1.329 million. That just cost basis is 1 million. The cost of sale is $59,000. Then the capital gain comes out to be like $269,000, and the taxable capital gain is 50% of it, which is $134,000. So this $134,900 of taxable gain does not consider the tax liability at the point of sale. Consideration will also be given to any recaptured capital cost allowance or an unamortized expenses to arrive at the taxable income on sale. The applicable tax rate for a taxpayer is then applied to the taxable income to arrive at the tax liability. Now, in case of an individual, the sale price is $500,000, adjust cost basis $47,000, cost of sale is $30,000, and the cost capital gain is $400,000. Capital gain versus taxable income. The Income Tax Act does not specifically set out whether or not the gain is capital in nature. The taxpayer is responsible for reporting the gain as income or a capital gain. This report may then be challenged by the CRA and with the onus of proof on the taxpayer. Over the years, the determination has been made based on a number of factors such as intention of the taxpayer, relationship to the taxpayer business, frequency of transaction, length of the time held, nature of the transaction, and object of the corporation. Should a debate proceed to the Tax Court of Canada, the court will consider relevant factors concerning taxpayer conduct before, during, and after the period under appeal. Certain factors carry more weight in the process. What was taxpayer intention at the time of when the property was purchased? Whether the property was brought in for investment, any resale profit could still be considered. Relationship to the taxpayer business. The tax code will undoubtedly classify profit as a taxable under ordinary business income when the taxpayer uses expertise acquired in the regular business activity to generate a profit on the purchase or sale of similar or other commodities. The code also looks at the time and attention the taxpayer spent on the transaction. Real estate transaction of contractors, renovators, brokers, and salesperson appraisers have typically fallen under close scrutiny. Frequency of transaction. Canada Revenue Agency will assess how often the taxpayer engages in the sale of capital property. Usually, frequency of such occurrences suggests the carrying of a business for profit. Assessment of ordinary business income will be the result. However, even an isolated transaction can be so judged given the right set of circumstances. Nature of transaction as a taxability as income may be indicated if the assets cannot normally be used either personally or for investment purpose. Mortgages are often judged under this test. If the mortgage is purchased at a substantial discount or has a short maturity period, the mortgagee may be viewed as being in the business that realizes profit from the transaction, thus invoking business income as opposed to capital gain. Objection of the corporation. The tax court will look at the articles of incorporation to determine if the transaction falls under the object of the corporation and if it's a part of the usual business. However, the absence of such provision may not be deemed conclusive by the court, proving that the specific sale fell beyond the normal course of affairs of the company. And once again, the burden of proof rests with the taxpayer. Special note: real estate transaction profits that would likely be taxed as a regular business if the taxpayer buys and sells real estate on a regular basis. However, if the taxpayer can prove that these dispositions were planned and necessary part of the total investment program, then there could be a case for capital gain investment for the profit. In case of farmland, if the taxpayer purchased and inherited the land and left it farmed for a period of time, the disposition of the property will most likely be regarded as a capital gain. Further, if sale of the real estate is not planned, that is, the brokerage are not employed and the property is not advertised, no signs or the visible evidence of active marketing is present, then the profit may be or always be treated as a capital gain. In some cases, the profit from the eventual sale of the property might be deemed as a capital gain when the taxpayer purchases real estate for a third party to whom he or she transferred to the taxpayer transfer it without profit but was left with the property when the third party backed out of the transaction. So again, there are a bunch of considerations which will define the whether the whether the property is for a capital gain or not. For example, the intention of the taxpayer, um, and the relationship to the taxpayer business, the frequency of transaction, length of the time held, and the nature of the transaction. So in this special note for real estate transaction, the profit may be taxed as regular income if the taxpayer buys and real estate on a regular basis. However, if the taxpayer can prove that these dispositions were a planned and necessary part of the total investment program, then there could be a case where capital gain again treatment for the profit. In case of a farmland, the taxpayer purchases or inherited the land and lived on it for for a period of time, the disposition of the property will most likely be regarded as a capital gain. Further, the sale of the real estate is not planned, and that is the brokerage is not employed, and property is not advertised. No signs of visible evidence of active marketing is present, and the profit may be but always be treated as a capital gain. In some cases, the profit from an individual sale of property may be deemed as a capital gain when the taxpayer purchased property for a third party whom he or she was expected to transfer it without profit, but was left with the property when a third party backed out of the transaction. Exemptions for the principal residence. Exemptions to the payment of capital gain have varied throughout the past decade. The major exemption for the real estate practitioner to consider involves a principal residence. A principal residence is defined as a house, apartment, in a duplex or apartment building or a condominium, cottage, houseboat, trailer, mobile home or sharing or cooperative housing corporation. To qualify for the principal residence, certain criteria must be met. The taxpayer must own the housing unit either jointly or solely. The family unit may have one principal residence. The land upon which the housing unit sits cannot exceed 1 acre, and any excess is not considered part of the principal residence unless the taxpayer can prove it is necessary for the personal use of the and enjoyment. The unit must be ordinarily inhabited in the year. The unit must be designated as the taxpayer principal residence for the year. Capital loss. So again, to recap, the taxpayer must own the housing unit. The unit family unit may have only one principal residence. The land upon which the housing unit is sits cannot exceed 1 acre. The unit must be ordinarily inhabited in the year, and taxpayer must be the unit designated a taxpayer principal residence for the year. Okay, capital loss is the loss that is incurred from the disposition of the capital property. Provision of the income tax act provide for reduction of capital losses for both individual and the corporation. The Expropriation Act. Expropriation in Ontario means taking away the private property by the state for public use with fair compensation to the owner through the exercise of the right of eminent domain. In Ontario, according to the Expropriation Act, the legislative definition of expropriation is taking of the land without the consent of the owner by an expropriation authority in exercise of its statutory powers. So let's look at the concept of eminent domain. Eminent domain is the right of the government or municipal quasi-public body to acquire the private property for public use. So eminent domain basically is the right of a government or the municipal quasi-public body to acquire private property for public use. Eminent domain is acquired through a legal action called condemnation or expropriation, in which the appropriate body determines the use is public use and it decides the price and compensation to be paid to the owner. The expropriation authority is the Crown or any other agency power empowered by the provincial legislation, namely an Expropriation Act. The legislation typically sets out procedures for application to an expropriation, appropriate hearing, and the method of compensation. There are provisions for compensation to the owner, and approval for the expropriation must be given by the approval authority. An owner who objects to the expropriation proposal can require a hearing. If expropriation is approved, there are specific procedures to be followed to determine the compensation to be paid to the owner. The basis of the compensation is a market value with a possibility of additional payment for damages, disturbance, relocation difficulties, and expenses. If the owner rights are interfered with or reduced, the owner may be entitled to compensation for injurious affection. As a form of appeal, the Ontario Municipal Board may be asked to determine the amount of compensation through an arbitration procedure. Expropriating authority. An expropriating authority is a crown or any person empowered by statute to expropriate land. The expropriation authority sets out procedures concerning the expropriation of land within the province. This act does not give the power to expropriate, as the power is found in the relevant statute. However, the act does give power to expropriate, as the power is found in the. However, the act governing the expropriation authority public. However, the act makes the expropriation activity public by requiring the expropriation authority to obtain confirmation of the approving authority. Following the notice served by the expropriation authority, the owner may request a hearing, unless ordered by the Lieutenant Governor in the Council. The Act then details the use of injury officers and power and duties of the approving authority. If the expropriation is approved, the registration of the plan concerning the land in question is then possible. The Act then sets out compensation methods involving special consideration, losses in tenant business, loss repayment of mortgage, injurious affection where the owner's rights are prejudiced or reduced in some way, and the special costs. Appeal procedures are also detailed, as well as the ability to issue a warrant concerning the residency, resistance to entry. A federal act concerning expropriation exists and can affect land in Ontario, but such matters go beyond the scope. Real estate practitioners are rarely involved in expropriation matters, however, understanding is required. A government agency adjacent to Smith property wishes to expropriate a small section of Smith rear yard along with the land of the adjoining neighbors to provide expanded area for buffer zone for a newly or badly needed building addition. The expropriation process will involve the application. The expropriation authority serves the notice of application on each registered owner. The notice is made by registered mail or personal delivery and 3 consecutive publications of notice in the local paper. Each property owner must be served, including the joint owner. There's a hearing, then the expropriation plan followed by compensation. and value of exploited land, and damages. Damages where involve disturbance, injurious affection, relocation difficulties, and payment to others. That there's a payment is made if there's a disagreement, negotiation, arbitration, and followed by the position. I think with this we are done with chapter 10. Thanks for your time. Let's just recap real quick. Section 16 of the Income Tax Act provides that a non-resident seller must pay the qualified percentage of the amount by which the sale proceeds exceeds the adjusted cost base for the property. The buyer can be ultimately liable for the tax remaining unpaid by the non-resident seller if such amount is not credited to the buyer. The seller, as an option to crediting the amount payable, may provide an appropriate certificate from the minister upon payment of the required amount. A capital gain is a gain on the sale and exchange of capital assets. The determination of whether or not a gain or a loss is capital in nature involves various consideration, most notably the taxpayer intention, the relationship to the taxpayer business, and the frequency of transaction. Various criteria must be met in order for a property to qualify as a principal residence and be exempt from the payment of capital gain. Eminent domain refers to the government right to acquire private property for public use. Compensation provisions for expropriation are based on the market value of the expropriated property. Expropriation procedures are complex and expert advice we should always be taken on this. With this, we are done with chapter 10. Thanks for your time.